Now, the second technique is analysis of financial statements. That is, whatever it may be, the financial statements that are prepared, they must be analyzed in a proper way. And in analysis of financial statements, we are having comparative statements, common size statements, and trend analysis. Comparative statement: to that of sales and various expenditures, we have to compare, we have to see the percentage, that is concerned per expenditure divided by sales into 100. Here, when you are going for the change, you will come across absolute change and relative change. So what is absolute change and what is relative change, sir? Absolute change is that change which belongs to any one unit of measurement, and relative change is the smallest change and which does not belongs to any units of measurement. That is nothing but relative change. So you have to take into account absolute change as well as relative change. So thereby the management people, they'll come to know what is the percentage of an expenditure to the sales, because sales is the primary source of income. Similarly, the other incomes, what is the percentage of other income to sales? So there you have to take into account absolute change and relative change. That is nothing but one technique for controlling the costs. The second one is common size. Okay, comparing the same units. Okay, comparing the same units which are very common. Okay, for example, A unit is there and it is having some print area, size, everything. Similarly, B unit also is having the same size, print area, everything is same. In that case, we have to compare the A unit as well as B unit. That is common size. Okay, and there you will come across the percentages, and there also you will come across percentages, and you have to compare each and everything. Okay, so you will come across comparative statement as well as comparative balance sheet. Similarly, common size, okay, profit and loss account and common size balance sheet also. So there we have to take into account the total assets and total liabilities. There we have to see each and every one to the total. Thereby you will come to know about the change that we will come across. That is nothing but common size. And the third one is trend analysis. What is the trend? At present, what is the trend that we have to take? And what is the trend of the past years? Basing upon the past year and present year, we have to forecast for the future year. What is the trend? Okay, like that, we will come across three techniques for controlling the costs. After financial statement analysis, you will have the same standard costing and variance analysis. So what is the standard? For every product, we have to take into account a standard unit. Okay, here when you take into account India ISI mark, when the product is having ISI symbol, then we can take that as standard product. Okay, standard product is that product, or standard is that standard, that cost. Standard cost is nothing but that cost where there won't be any discrepancies, where there won't be any differences. Okay, regarding the material, regarding the labor, regarding the overheads, whatever we take. Okay, we have to take in a calculated manner and we have to do the cost. And this standard cost is more useful for variances, for finding variances. Okay, how, sir? How will get the variances? The variances are standard cost minus actual cost. Sometimes standard cost will be more and sometimes actual cost will be more. So when standard cost is more, it is nothing but it is treated as favorable, and when actual cost is more, it is treated as adverse. So when you go for variance analysis, You'll come across favorable and adverse. And in variance analysis also, you will come across material variances, labor variances, and overhead variances. Okay, these are the variances that we come across because elements of cost are materials, labor, and overheads. So you have to take variances in these three elements of cost: materials, labor, and overheads. And the overheads, they may be fixed overheads or they may be variable overheads. And another type of variable overheads we'll come across. We'll call them as semi-variable cost. Semi means some portion belongs to fixed and some portion will belongs to variable. That is, you will come across fixed cost to certain extent and variable cost to certain extent. So whatever it may be, we'll call that thing as semi-variable expenses, semi-variable cost. When we come across semi-variable costs, in practical life, they won't take as semi-variable expenses or semi-variable costs. They'll take into account the fixed portion and they will add to the fixed expenses or fixed costs. Similarly, they will add the variable expenses or variable cost to variable costs. So there you will come across fixed cost and variable cost. And this fixed cost and variable cost, they are very, very essential. Okay, they are very, very essential for finding out the variances. Which one is fixed and which one is variable. And this fixed cost and variable cost you will see when you are going to study this marginal cost. When you are going to study the marginal cost, you will come across all these things. Okay, fine. After variable cost, after variances, the next technique is funds flow analysis. Actually, fund means generally people they'll take that as reserve fund or general reserve, whatever it may be. But the actual meaning of fund is nothing but working capital. So, what is working capital? Working capital is nothing but the difference between current assets and current liabilities. When current assets are more than current liabilities, then the working capital will increase. When current liabilities are more than current assets, the working capital is said to be decreased. Okay, for any business, when you are going to start a business, you have to take into account two types of capitals. Two types of capitals, not basing upon the number of shares I'm talking. Okay, basing upon the functional analysis or functional classification. Fixed capital and working capital. Fixed capital is there or is that capital which is used to purchase the various assets which are useful for the business. Working capital is the capital which is used to meet day-to-day expenditure. So every businessman, they must have this differentiation. What is the fixed capital? What is the working capital? How much we have to keep as fixed capital and how much we have to use as working capital. This thing they have to take into account. Okay, so fund is nothing but working capital. And when you are going for working capital, you will come across changes. It is quite but natural. There will be an increase in working capital or a decrease in working capital. As I told you already that when current assets are more than current liabilities, then it is nothing but increase in working capital. When current liabilities are more than current assets, it is nothing but decrease in decrease in working capital. Then funds from operations. So when we are doing some operations, automatically some funds we will come across. So what are they? Okay, unnecessary things that we will charge in financial accounting. For example, depreciation. It is nothing but a charged loss. Okay, amortization of goodwill. It is also. And decrease in value of fictitious assets. Transfer to general reserve. When you get some amount they will transfer to general reserve for future purpose. So these are nothing but non-income or non-income items, non-trading items or non-income items. This thing you have to add to the profit, and whatever it may be, the losses, not incomes, please, sorry, the expenses, whatever you are charging, that is provision for taxation, provision for doubtful debts, all these are nothing but the expenses. This non profitable expenses you have to add, and you have to deduct non profitable incomes. Then only you will come to know about the funds from operations. And after preparing the funds from operations, you have to go for funds flow statement. Funds flow statement, it includes the sources of funds and applications of funds. What are the sources? From where we are getting the funds and where we are applying the funds. That is most important. And when the sources total and the applications total, when they are one and the same, then it is nothing but one technique to control the costs. Because whatever it may be, the sources that we are getting, and we are applying the sources, I mean income or funds, whatever it may be, to various these things. So automatically the totals of sources and applications, they will be one and the same. So funds from operation is nothing but one important technique to control the costs. And the last one is cash flow analysis. So what is this cash flow? It is similar to that of funds flow analysis, but here what is the inflow of cash and what is the outflow of cash? So if you remember the preparation of cash book, then you can easily understand about this cash flow analysis. In cash flow analysis, we won't come across different statements, only two statements: cash from operations and cash flow statement. Cash from operations. So here we have to take into account the same net profit and whatever it may be, non-trading items, that is non-trading expenses, whatever it may be, we have to add, and non-trading incomes we have to deduct. Thereby we will come to know about the cash from operations. Then after that you have to go for cash flow statement. When you are going for cash flow statements, you will come across three activities: operating activities, financial activities, and investment activities. First, we have to take into account the operating activities. What are the operating activities that we come across, and what is the result? There also you will take into account the favorable as well as adverse. Okay, sometimes you are getting adverse, that is minus. Sometimes you will get plus, that is favorable. So what you have to do is you have to take into account the operating activities, next financial activities regarding issue of shares or redemption of shares, redemption of debentures, all these things we have to take into account. So what is the net, this thing that we got, net result that we got, we have to take, whether it is an adverse or whether it is a favorable. Then after that you have to go for investment activities, where you have invested, so that thing also we have to take into account. And after taking into account all the things, you have to add, and for that quotient you have to add the opening balance of cash. Thereby you have to get the closing balance of cash. So when you do like that, automatically you will come across a cash flow statement. This cash flow statement, that is, when you take into account operating activities, investment activities, and financial activities, and when you are adding the opening balance, when you are getting the closing balance exactly without any difference, then automatically we can say that the cash flow is smooth. There you have to take into account the current assets as well as current liabilities also. Okay, in addition to that, in addition to the operating activities, investment activities, and financial activities, you have to take into account changes in the assets and liabilities. And when you come across a change in assets, that is assets value, when they increase, automatically it is nothing but a favorable this thing. Okay, so whether the asset is decreasing or increasing, when the assets is decreasing, it is nothing but source. When the asset is increasing, it is nothing but an application. Similarly, liabilities, when it is decreasing, it is a favorable thing. When it is increasing, it is an unfavorable thing. So like that, you have to take into account all these things, and you have to find out the cash flow statements. So these are the various techniques that we come across when we go for cost control. So cost control techniques are marginal costing, as I told you, marginal costing, budgetary control, budgets and budgetary control. Next, after that, uh, the standard costing and variance analysis, and ratio analysis also is one of the important technique. That is, we have to take into account the ratios. What is a ratio? Expressing a number in terms of another number is nothing but ratio. Expressing a number in terms of another number is nothing but ratio. So ratio analysis also one of the important techniques that we come across. So each and everything I'm going to explain in the future classes, further classes. If it is good, please subscribe to my channel. Thank you.